Okay, last week had a lot of content. This week, chapter 20 focuses on how to build a budget. And so the hardest part about building a budget is knowing which piece goes next, and we'll talk about that. And it's one of those things where if you start getting it wrong, then everything's wrong, right? It's really an important subject because it's something that most of you, if not all of you, will be involved in professionally. However, most of you, at least for the next foreseeable future, won't be responsible for being involved with all the parts of the budget, because what happens is, like, each department will do their own piece of the budget, right? And then somebody else puts it all together. But even for that piece, it's helpful to know how all of the pieces go together. So we're going to focus on in this chapter, like how you put together a budget from beginning to end. Then we're going to look at how you analyze a budget, like the purpose of the budget, what you use a budget for, how you analyze variance differences between what actually happened in the budget. When we look at flexible budgets, that's not a big deal at all. Once you understand the budget process, which we do in chapter 20, once you understand the budget process, then what we have is a flexible budget is simply adjusting for what actually happened. Because let's say I budgeted, that I was going to sell $200,000 worth in sales, and I got a new contract that I didn't expect, and they increased my sales 25,000. If I just use my old budget, my sales revenue is going to look like it's, like I'm doing great. I mean, I'm over on sales. That's wonderful, right? But what are my expenses going to look like? If I pick up a new client I wasn't expecting, it's not in my budget, what's that going to do to my expenses?
It will increase.
Right, and my expenses are all going to look overstated, but they aren't really. So all a flexible budget does is says, okay, so let's increase the sales to what they really are, so that we can look at what the expenses would be if we had that amount of sales, so that you can really compare apples and apples. Otherwise you aren't. So there isn't a lot to doing a flexible budget. And the way the textbook will explain it to you is that you do a budget, like for 5,000 more and 10,000 more and 15,000 more. But that's not really true anymore, because in Excel, all we have to do is go in and change one number, right? I mean, budgets used to be really hard. This is where the rooms of accountants came from with the green bar paper, because when you walk back out and they're like, that's really good. But what happens if we increase our sales 12%? And then you're like, I'll be back in 3 days. Let me just go recalculate every single number in the budget, right? And it's not that way anymore. So the concept of what goes into a flexible budget is important, but the method that we use is a lot simpler, because when you build everything in Excel, you tie all the pieces together. So the two biggest things are how to make a budget, period, from start to finish, and then how to analyze the differences between what happened in actuality and what we plan to have happen. So we're going to start with 20. So can everybody see the slide for chapter 20?
Yes.
Okay, just wanted to make sure I was sharing it so we didn't get halfway through and go, am I supposed to be looking at a slide? I'm like, oh, yes. All right, budgeting. There we go. I kind of took out a lot of this, but I think it's important to mention, because we think of budgets and we think, oh, well, that's so that we have, a difference between the dollars, and we can see, where we're at as far as where we plan to be. But there's actually a lot more important even benefits in budgeting, because when you budget, management has to sit down and communicate and figure out priorities, because just like at home, it's like the difference between a goal and a dream is writing it down, right? All those people that say they'd love to have a degree, you're so lucky to be getting a degree, but really the difference is that they don't want to do the work, right? Well, with budgeting, it's like this is where you put the money. You know, like last year, yes, I wanted to move, and yes, I wanted to take a vacation, and yes, I wanted to do all this, but what I really wanted to do was get stuff for us to do with the kids as a family. And so we bought kayaks and we bought a camper. And the fact that that's where I decided to put my money, that was my priority. I had to plan for that. And so it's the same thing with the company. When you sit down and you start looking at your priorities, where you decide to spend your money on the budget is important. And it shows a lot more about, it helps you refine your goals. Now, after you do the budget, obviously, another primary benefit of the budget is that we use it for benchmarking and for, figuring out, are we on target with sales? Are we over with expenses? How does everything seem from a control standpoint? Okay, so here's the process of preparing the budget. And the most important thing is the thought process so that when you go to work through it, it makes sense. These are the components. We start at the top. The budget is driven by our sales projection. And your sales projection is typically given to you by senior management, right? But and a lot of companies will do their sales projection based on, a certain percentage over what it was last year, or they might do it based on decreasing if the economy has gone down, or goals for picking up a different profit line or something. But the entire budget is driven by sales. So the first thing you do is you figure out how much you plan to sell and how much that's going to bring in. Then based on what you're going to sell, you're like, okay, well, what do we need to produce in order to meet those sales goals? So your production budget is the second component. So there you're looking at what materials, what labor, what overhead does it take to make us, to get us to produce whatever units we have to produce. Then completely separate from that is the capital expenditures budget, is for things like if you were at home, it'd be your car, and, do we want to buy a house? Do we want to buy a new refrigerator? For a company, it's, do we want to replace the cooling system? Do we want to buy a new delivery van? Do we want to purchase a new building? Those are all capital expense. Do we want to buy a new piece of machinery for manufacturing our product? That's all capital expenditures. And then selling expenses, general and admin, are things like human resources, payroll, the sales department, senior management. And all of those pieces contribute to the cash budget, either flowing into the cash budget as revenue, like from the sales, or expenses, like from the production and the capital expenditures and the selling, admin, and expense budgets. When we're all done, we actually use the numbers from our budget to manufacture budgeted financial statements. Okay, let me rephrase that. To compile budgeted financial statements. To manufacture them sounds like, oh, we make it all up. No, to compile the budgeted financial statements. So we're going to start with the sales budget. And where the sales budget works is we figure out how many units do we expect to sell, and how much are we going to be paid for those units? And that's what makes up the sales budget. It sounds simple, and the sales budget really is. If the company is large and has several divisions, then the sales budget is done for like each product line. Like, let's take a university, because you're familiar with how the university works. You've got your like health, like maybe your nursing program, and you've got your business program, and you've got your education program. Each one of those would have separate budgets, and it would all roll up in the sales budget. But each department, like the business program, would be figuring out how many students they were going to get in the business program, how much dollars we're going to come in per student, and each department would be doing that. So the iterations might be many if we have a lot of different products or services, but the process is exactly the same. So we're going to figure out, how many units do we plan to sell, and what's the selling price per unit, and that's going to tell us what our sales budget is. So let's say that Toronto Sticks Company sold 700 hockey sticks at $60 each. So if we're going to do a budget for the next 3 months, it might look like this. where we say, okay, our budgeted units are in October 1,000, in November 800, December 1,400. By the way, why do you think there would be that uneven amount in sales? If you're putting together a budget, why might it be higher, especially for hockey sticks? Why might it be 1,000 in October, then 800 in November, and 1,400 in December?
Because some stuff is seasonal.
Because some stuff is what?
Seasonal.
Okay, it is seasonal. That's one part. Why? There's something else that I see here, though, because you might be playing golf in November in Florida, but why the dip in November and the increase in December? What happens in December? Christmas, right. And so the other thing that happens is people don't buy in November because they're going to buy in December for Christmas, right? I mean, if you're buying like golf clubs. So when you look at a budget, it's not a flat amount each month. You have to take into account, you would look at the history, your cyclical nature of your sales. And, you would figure out, like when we did our cushions, obviously, well, when we were retail, sales were a lot higher in the summer. That's why I started doing resorts, because resorts do all of their production and their building and stuff in the winter months. So they did theirs, and then I picked up manufacturers, because manufacturers do a lot of their furniture manufacturing and sales between November and March, so that they get it to the furniture stores. And by the time they're done, retail customers are buying again. So I actually solved part of that cyclical pattern by picking up different customer bases. But when you look at it by month, you have to take into account, that every month isn't going to be the same. So when we do this, the first thing we do is we figure out our budget and sales in units. And we would start with historical data to look at what that might be. Then we take our selling price per unit, and that gives us our total budget for sales for each month. So now we have put dollars to the number of units. Now, so if we sold, which we would, all different hockey sticks and helmets and pucks and gloves and pads and all of that, we would do exactly the same thing. We just have multiple lines for the different products that we were selling. Okay, are we good here?
Yes.
Yes.
All right, so once we've done our sales budget, now we're ready to do our production budget, because our sales budget tells us how many units we need to produce. Our production budget looks at, what does it take to produce those units? What do I need to bring in to be able to sell that many of whatever I'm going to sell? So here we've got like the total units to be produced. But a lot of companies, first of all, a lot of companies do two things. They hold they want to have some inventory at the end of the month. Because if somebody comes in on the first of the next month and they want to buy a hockey puck or a hockey stick, you're not going to say, oh, I'm sorry, the last day of the month we sell out all of the hockey sticks and we're waiting for the new ones to come in, right? You're going to want to have some hockey sticks there to sell on the first day of the month. So you do that by keeping some ending inventory in stock. So when you're planning your production budget, you're looking at, how much do I have to start with? How much do I need for this period? And how much do I need to have left over at the end of my period? And you look at it backwards. So it's like, okay, so at the end of the period, let's say I have nothing, right? If we go back and look at our sales budget, maybe we won't go back and look at our sales budget. So if I say, okay, 1,000 units, I'm going to sell 1,000 units in October. So what I'm going to look at is I'm going to say, okay, how many units do I want to have at the end of the month to start out the next month? Let's say I want to have 100 units on hand at the end of the next month. So I need 100 units plus my 1,000. So I need 1,100 units. And then I say, well, what do I have already made? You know, it's like, so maybe I have 50 units already made. So I subtract that. And that's how I know how many units I need to produce. I figure out, what do I need to have in ending inventory? What do I want to have left over at the end of the month? Plus what I need to make for this period. That's what's required this period. Minus what do I already have? What do I anticipate having? And that's going to tell me how many units I need to produce. So the first thing that you have to figure out in the production budget is, how many do I have to make? So here's our production budget. I'm going to make it bigger because it's hard to read. Are the pictures in the way or anything? Can you read the numbers?
Yes.
Okay.
Yes.
Okay. I was doing another class the other day, and I realized that sometimes the picture's in the way and I don't know it. So please tell me, because apparently it doesn't look the same on mine. I think I'm going to set up a second computer one day so I can see it.
Yeah.
But it explains, yeah, it explains why my, what?
It's in the way. I can't see the numbers.
Now can you?
No, but I'll just follow the printout slide that I have.
But what, okay, oopsie. But see, mine's like on the very top. Can you move your people?
Yes, you can move it.
Because I moved mine to the very top. Can you?
Okay,
yeah,
I did. I didn't know I could do that.
okay, good. All right. Well, because my daughter will be watching her Spanish video, and the teacher will be on top of the word. You know, and it's like, well, I don't really know what that word is because there are pictures there.
Okay, I didn't know I could do that. Just
yeah, you
learned.
can do that. Okay, good. Yeah, when you guys can't see something, please say something, because I want to know that. I don't intend for you to not be able to see what's on the screen. That would be like completely ridiculously stupid.
Yes.
Even after falling on my head, I wouldn't do that. Okay, so now I'm going to move this down here because I want to see if I can write here. I'm always moving my stuff around too, by the way, so that I can get at everything.
What would solve the problem is if you get two screens.
Yeah, I actually have a monitor that I never use, and I'm thinking of setting it up here and trying that. That's the thing I still haven't tried.
Yeah, I have two monitors for work, and it's the best.
Is it? See, I've always thought it'd be one of those things that once I tried it, it would be like, it's like this tablet. I had it for like a year before I used it. And I've always thought if I used two monitors, it would be one of those things where it'd be like, oh my God, how did I ever teach without this?
Mm-hmm, exactly.
Okay, so when we look at, so I'll try that. By the way, who just said they used two at work?
Jose.
Okay, then I know who to call when I'm trying to do it if I get stuck. Wait, why did I delete that? Okay, so here's what we started with. Just gonna highlight, no. So here's what we started with. We started with, I hid my highlighter. Yeah, see, now I can't even, there we go. Oh, neat. Okay, so here's what we started with. This is our sales amount, and this came from our sales budget, right?
Mm-hmm.
So now what we're going to do is we're going to say, okay, if I'm going to need to sell 800 units, I've decided that the ratio of inventory for future sales is 90%. So in other words, I want to keep 90% on hand, which is really high. I want to keep 90% on hand. So if I need 800 units and I want to keep 90% on hand, that means my ending inventory at the end of the month needs to be 720 units. Plus, I need 1,000 units for the next month's sales. So I have to make a total for this month's sales. These are 1 month forward. So for this month's sales, I need 1,000 units. So I'm looking for a total of 1,720 units. I already have in beginning inventory from the previous period, 1,010. So that means that I need to produce 710 units. Now let's look at the next month, okay? So the next month, we're going to start with our next month's budget is 1,400 units. I need to keep 90% on hand. So at the end of the period, I want to have 1,260 units in ending inventory. I have to make 800 units for sales. That means I need a total of 2,060 units. I should have 720 in ending inventory. That's what I set aside at the beginning of last month. So I should have 720 in ending inventory, which means that I have to manufacture a total of 1,340 units. So then in the next month, we have 900 that we need. We want to hold 90 back in ending inventory. So here's what's going to be on our ending inventory. This is for our sales. So this is the total. This is what's in our beginning inventory from the previous period. And this is what we have to produce. So it's hard to get it set up to begin with, but once you start going with it, it kind of just keeps rolling. All right.
I have a question.
Uh-huh.
For October, the 1,000 in budgeted sales units,
Mm-hmm.
where does that number come from?
From here. Our budget was 1,000 for October, 800 for November, and 14 for December. So when we go over here, our budget.
Oh, I get it.
Right,
I get
it was 1,000, 800, 1,400. And then this 900 would be for the 800 goes here. This 900 would be for January.
Okay.
Because what you're planning here is
Got it.
okay. So this is the beginning of the hard part, because with this we're figuring out, okay, what do we have to produce? When we're done with this, we know the units to produce. Everything's in units. We haven't figured out any dollars yet. All right, are we good here?
I have a question.
Uh-huh.
How do we get the 90%?
That's given to you.
Oh, it's given?
Yeah, that would be like something that management would decide, you know, that we want to start the month with 90% on hand.
Okay, got it. Okay.
90% of our next month, 90% of our next month's sales. So what we're saying here is next month we need to sell 800 units.
Right. Okay.
We want to have 90% of this is for November, right?
Okay.
So in November we're going to sell 800 units.
Okay.
We want to have 90% of that on hand at the end of the period before. We want to start with that.
Okay.
So we want to start with 720 units.
Okay. And
So we have to produce that 720 units for November, plus the 1,000 for this month.
Okay. The 720, is that given as well? Or
The 1,720, we're going to roll over because this is a total. So this is saying, okay, so for next month, for ending inventory, we need to have 720 units.
okay.
Plus we have to make 1,000 for this month.
Okay.
So the total number of units that we have to manufacture is 1,720.
Okay.
But we already have in our beginning inventory 1,010.
Right.
So we only have to actually produce 710.
Okay. Okay.
So then for the next period, we say, okay, so for December, we're going to need 1,400 units.
Right.
We want to start the month out with 90% of that.
Okay.
Are we good?
Yes.
Okay, it is confusing. All right. Okay, so now we're going to go. What? You're going to. Now we're going to go a little bit farther. Now we're going to put dollars. Now we're going to put, now we're going to figure out materials in dollars. So how much materials does it take to manufacture the products, and how much is that going to cost? So these numbers should start to look familiar. So we started off with, we're going to produce 710 units. That came from, we're taking from our bottom line. So we're taking from here. So when we go to here, we say, okay, now we have the number of units we're going to produce. Now that's all we're going to worry about here. We're going to say, okay, if we're going to produce 710 units, we require 0.5 whatever material. Like if it's a pound, we require 0.5 pounds, right? Pounds, it is pounds. So we require 0.5 pounds per unit. So if we're going to produce 710 units, each one takes half a pound of material, we need 355 pounds of material. Does that make sense so far?
Yeah.
That sounded like a very tentative yeah.
I'm working on it.
Okay.
That 710 is that, I see the red. Is that a minus?
No, I'm just saying, sorry.
Okay. Okay.
So if we're going to make 700, if we're going to produce 710 units, which came from the bottom line in our production budget, 710 units. If we're going to make 710 units and each unit requires a half a pound of material, we need 355 pounds. Now we have to say, okay, what about ending inventory? So for ending inventory, we're going to have 670 units. So times 50%, here's our ending inventory. We need 335 pounds for ending inventory. So we're going to need to purchase a total of 690 pounds minus what's in beginning inventory. So we have to purchase a total of 512 pounds. So this goes the same way the other one does. This goes the same way the materials, the production budget goes, where we're still saying, okay, here is what's required times the amount plus ending inventory minus beginning inventory gives us our total. So like here now we're saying, okay, we're going to make 1,340 units. At a half pound per unit is 670 pounds we need to purchase. Plus we need 50% of what's going to be left over next period. So 475, so we need to purchase, this is what's going to be left in ending inventory, the materials for ending inventory. So we have a total of 907.5 pounds. Minus what we started off with in beginning inventory, so we have to make or buy 572.5 pounds. After we figure out how much we have to purchase, then we put dollars to it. Now we're going to do dollars. We're going to say, okay, if we need 512 pounds, we're going to estimate the pounds are $20 a pound. So this is our cost. So because we're only doing 512 pounds in October, it'll be 10,240. For November, it'll be 11,450. And for December, it's 9,700. Okay, now let me ask you something to see if you understand how this works. If our sales are higher in December than they are in November, why is our cost higher in November than it is in December? If our sales are higher in December than in November, why are our costs higher in November than in December? What happens with our sales dollars? And what about ending inventory?
Producing more.
We're producing more. We're producing more in November to get ready for December. Because remember when we looked at this? Just a minute. Somebody else has a kitty.
She's very, she likes a lot of attention.
So does mine. Okay, remember when we looked at this? No. God, I can't back up. I've got like everything covering my. Okay, I'm gonna close chat pod for a minute. All right, remember when we looked at the production budget? We were actually going to produce, we needed to produce 1,340 units in November and only 950 in December. Because with our sales budget, we're selling 1,400 in December and only 800 in November. But because we keep 90% on hand for the of next month's sales, that means that we do a lot of the production for the next month in the previous month. That's why when we get down here and we're looking at materials, we have to purchase more materials in November and make more product in November than we do in December because we make our product 90% ahead of time. That make sense? Okay, we're just going to keep talking about it until it makes sense.
I have a question.
Yeah.
The 670 in November under materials needed for production, why does that go to the budgeted ending inventory in October?
Because that 670 is what I need to produce for November, and I need to have half of that. I need to do that this month because that material needed for production in November is, I'm starting out with my budgeted units and my 50%, so 670 because I'm going to keep an ending inventory half of it.
Okay.
Well, not I'm going to keep an ending inventory half of it. That's what I need for production, and 50% of my units is what is my materials. So in order to have that 670 there ahead of time, I need to buy 335 pounds of materials.
Okay.
We're going to do, so now we know how much our materials are going to cost. Now we have an idea, and these dollars ultimately will flow to our cash budget. Now the next thing we're going to do is we're going to say, okay, to make these units, what do I have to do for labor? So here we are back with, these numbers should look familiar. So we know how many units we're going to produce. We're going to produce 710, 1340, and 950. We know that each unit requires 15 minutes of labor. So this part's easier because we don't have to figure out beginning and ending inventory or anything. All we have to do is say, okay, bottom line, which came from here, right? Our production budget. Bottom line for our production budget, these are the units that we're going to be producing. We take this, so these come from our production budget, straight from the bottom line. And this part's easy. All we have to do is say, well, if we're going to make a total of 710 units, each unit takes 15 minutes. I need 177.5 hours of labor. My labor rate is $12 an hour, so I'm going to spend X amount of dollars each month. Now, let's say that this was a more complicated budget. Let's say you were doing a school. You actually put in that budget, you know, like, I know what my salary is. It goes into the budget. I mean, I am a line item in the budget because I'm not, I mean, we have so many faculty, they're a line item in the budget. We know what we're going to pay them. And so, like when I did the budgets for our company, I mean, I knew, you know, my operations manager's salary went directly in. My seamstresses, you know, if I knew what their costs were, they went directly in. It was only if I was going to hire somebody that, you know, I wasn't planning on that I would use an average salary. So it can become more detailed. You know, like if you know your manager's salary, it will actually go in, you know, in the dollar amount that it actually is, right? Even in your budget, because that's a big part of planning. I'll be done in 10 minutes. I'll be downstairs. Okay, so we take our direct labor rate, and that gives us our total cost of direct labor. All right, this one's easier. Does this one make sense? I'm going to sit here until I know it makes sense.
Yes.
Yes, this one does.
It makes
Yes.
sense.
See, I refuse to lose you guys. It's just not going to happen. Okay, well, because if you get lost in one place here, then you're lost, right? Okay, so now we have our labor. We have our direct materials, direct labor. So what do you think is coming up? What goes in that account? We have our work in process account. And what goes in there? Remember, direct materials, direct labor, and what's the other thing?
Ooh.
Don't you wish I wouldn't bring up these things from the past? What did we learn how to do an allocation rate for?
Overhead?
Yeah, manufacturing overhead. Okay, so we've done direct materials, direct labor, and now we have to do manufacturing overhead. So manufacturing overhead isn't that hard either. We start out with the same production units that we had already planned on, so that keeps carrying over and should look familiar. We know what our variable factory overhead rate is because how did we get that? This is our estimated manufacturing overhead rate. So that gives us our budgeted variable overhead. Our budgeted fixed overhead is based on historical data. And that's how we get our total for budgeted overhead. So we have to use our estimated overhead rate for variable overhead, and then we do our budgeted fixed overhead based on historical data, and we're done. So the one that's really hard is production. Okay, so now we've taken this and we have dollars for this too. So now we have dollars for our product that we have to purchase, our materials. We have dollars for our labor to produce, and we have dollars for our overhead. So now we finish this. Oopsie. We have our direct materials, direct labor, and manufacturing overhead from our 3 budgets. Now let's say we wanted to figure out for budgeting purposes our cost per unit. Now we can do that from here because we know how much the direct materials are and we know how many units we're producing. We know how much the direct labor is and we know how many units we're producing. And we know how much the manufacturing overhead is and we know how many units we're producing. For instance, right here for October, how much is my manufacturing overhead per unit?
$2.50.
Right, so I'm going to do that by saying I'm spending $3,275 to produce 710 units, and that ends up at, what did you say, $2 and...
50 cents.
Is that right? You know, my number sense has gone out the window with my concussion. Not a good thing for me. Okay, does everyone agree it's right? No, it's not. 3,275 divided by 710. That's $4.61. Would somebody check the number?
It's
Ladies.
461.
It's 461. Where'd you get that?
Yeah,
Where'd you?
I misunderstood. I was looking at the factory overhead rate for October at 250. Yeah, I was looking somewhere completely incorrect.
Oh, okay. I'm just glad my number sense isn't completely gone because I was looking at that thinking, that seems low. And I thought, well, it's probably me. So 462.
And what is this? The 462 is equal to what?
So this is the per unit, cost per unit for October. Because what we're going to do next is we're going to look at cost per unit. So for overhead, if I wanted to know what's my cost per unit for October, I'm going to take the 3,275 divided by the 710. If I want to know cost per unit for manufacturing overhead for November, I'm going to take 4,850 divided by 1,340 units. Which is going to equal what? I've got to take the password off my computer.
Would it be 3.62?
I'll go with that. Per unit. Does that make sense?
Yes.
So the next thing we're looking at is now production per unit. So all we've done here is we've said, okay, the pieces of our production are direct materials, direct labor, variable overhead, and fixed overhead. And we already know what each one of those is worth because our direct materials was a half a pound at $20. So each unit uses up $10. Our direct labor was 25.25, so 15 minutes at $12 an hour. So our direct labor for each unit was $3. Our variable overhead, using our predetermined overhead rate, is $250 per unit. Our fixed overhead, we said, was 4,500 square feet, 4,500 total fixed overhead per 3,000 units of expected production. So we calculated our fixed overhead here at $1.50 per unit. So what we've come up with is the total for our units. So we're saying, okay, our total production cost per unit is $1,700. And that's based on direct materials, direct labor, and manufacturing overhead. but we split manufacturing overhead into fixed and variable. But we still have direct materials, direct labor, and manufacturing overhead to figure out what's our per unit cost. So now we have, okay, each unit costs us about $17 to produce. Still with me?
Yes.
Is anybody else still with me? Okay, good.
Yes.
Yeah.
Okay, so now it gets easier. Now we're going to look at our selling expense budget. And for our selling expense budget, we'll say, okay, so how much does it cost? So we have commissions, and commissions are typically 10% of sales. So whatever our sales are, the commissions are going to, go up or down. And we have our monthly salary of $2,000 for the sales manager. So we know what our additional selling expenses are, and we'll put them into our selling budget. So we have to figure out our sales to do our commissions. So we're taking our budgeted sales each month. Where did our budgeted sales come from? So our budgeted sales, we're always looking back. It's like, where did this number come from? So our budgeted sales, 60, 48, 84.
Came from the sales budget?
Yep, came from our, there we are, from our sales budget, 60, 48, 84. So now when we go figure out our selling expenses, all of these come from, oopsie, from the sales budget. We're going to go back to the sales budget, and we're going to say, okay, what are our sales dollars, our sales units, sales dollars? So if we're going to sell 60,000, we're going to pay 10% in commission. So our commissions will be 6,000. The 2,000 manager salary is fixed cost. So our total selling expense will be 8,000. And we'll do the same thing for each month. So that part's really straightforward and simple. It doesn't feel that way because of all the other things we're doing. I know. Oopsie, I didn't take this out, meant to. Okay, we've done the hard part. Now we're going to take the cash budget. The hardest part about the cash budget is knowing where to go to find everything. So we have our beginning cash balance. Now, the cash budget is not the same as a cash statement, the cash flow statement. Cash budget is really like what you're thinking of doing at home, with when do I get my paycheck? When am I going to pay the rent? When can I buy the new tires? When can I pay the orthodontist? That's our cash budget. So we have our beginning cash balance plus what we plan to bring in. And what we plan to bring in comes from our sales budget, minus our budgeted cash payments, which comes from several budgets, gives us the cash balance we think we'll have. And then we look at whether we're going to have enough or we're going to be short. Well, we're going to walk through it. So a lot of companies will say, like, I want to have a certain amount remaining at the end of the period. So, and the other thing is, when you're looking at cash, you have to estimate, because some people come in and they pay cash, right? Other people pay on credit. So just because we make a sale this month doesn't mean we're going to receive cash this month for it. So for this company, 40% of the sales each month are in cash, and 60% are collected in the following month. So when we look at our cash flows, we're going to take the sales amount for that month. 40% of it will get in cash. 60% will get in the next month. So when we do that, it's kind of like it's rolling. So when we looked at this, we're like, okay, we knew our sales dollars for September were 42,000. We were given this number because this came from historical data. We had accounts receivable already from the prior month. because we're just starting in September. So we would have had August, and whatever sales were made in August, 60% of them would be collected this month, right? So in September, we sold 42,000 in sales. We collected cash, but we're not doing that. We're only doing October, November, and December. But 60% of what we sold in September has not been collected yet. This is accounts receivable from September sales. So now in October, we know that we're going to sell 60,000. We are going to have 60% of that will not be collected. Right off the bat, 60% will not be collected. It'll be collected in the next month. So we're going to take that 60% off. But we're going to collect 40%. So this is the 40% of that. So we're going to collect $25,200. I mean, we're going to collect $24,000 from the October sales of 60,000. We're also going to collect what's left over from the September sales, the 60% of last month's sales. So we're going to collect the $24,000 from this month and the $25,200 from last month, which means that we expect to collect $49,200. Now that $49,200 becomes our beginning balance in the. Oh wait, no, because it's not the cash part yet. It's only sales part. Great. Why doesn't my eraser like me? Oh, I have to hold it there. That's different. Okay. So in November, we plan to sell 48,000. Of that 48,000, 60% won't be collected until the next month. That's the 28,800. 40% will be collected. That's the 19,200. We'll also collect the 60% left over from the previous month. That's the 36,000. So in November, we should bring in $55,200. In December, we have 84,000 in sales. 60% of that won't be collected this month, but we'll collect 40%, which is the 33,600. We'll also collect the 60% left over from November, the 28,800. So we'll end up bringing in 62,400 from sales. All right, are we good here?
Yes.
Okay, so that's where we're bringing cash in. We bring cash in from sales. Now we have to look at how cash goes out. So the way cash goes out is the same as the way cash comes in. When we have cash go out, a lot of the times we might buy something for totally cash, but often we'll buy something on account and pay for it later. So in this company, our materials are based entirely on account, which means no materials that we buy this month we're going to pay for. We're going to pay for everything in the month following the purchase. So whatever, and this could change by company, so whatever our purchases are, we're going to pay for them in the next month. So every month, our cash payments for materials will be based on our last month's materials. Okay, so we have cash payments for materials. So we're starting here and we're saying the materials we purchased are $10,400. These are from our direct materials budget. You have to know which budget to look at. So we're going to go to our direct materials budget to see what materials are we going to buy. So we have to purchase $10,240 in materials. We're not going to pay anything for this month's sales purchases, but we still have to pay for last month. So this number you would be given. You'd have to be given your first period for a problem. So we know that for October, we're going to spend $7,060 on purchases. For November, we need $11,450 in purchases. We're not going to pay for any of that this month, but we're going to pay for last month's.
Oh, I get it.
So our total is going to be $10,240. In November, we need $9,700 in materials. We're not going to pay for any of that, but we're going to pay for last month's.
Oh.
So our total purchases that we're going to spend money on is going to be $11,450.
Got it.
Yay!
Now, this question may be irrelevant, but why would we pay a month behind?
Because we're buying it probably on net 30.
Sure.
Got it.
Which really isn't uncommon. Like I used to buy all of my foam that way. You know, we're going to pay for it next month.
Gotcha.
All right. I know. So now we have the cash budget. And the cash budget becomes a little bit complicated because we have these pieces from different areas. We've got, you know, the sales budget that gave us our cash receipts. And then we have the purchases budget that gave us our cash payments. And so we have to put all this stuff together. Now, in addition to that, we know that we're going to start with the beginning balance of $20,000 and that we want to pay a cash dividend of $3,000 in November. So here's what this is going to look like. We also know we have to record an income tax liability of $20,000 in October. We want to purchase $25,000 of equipment in December. We have an agreement with the bank to keep a minimum cash balance of $20,000, which means if we don't have $20,000 at the end of the month, we're going to draw on our line of credit. We're going to pay interest each month equal to 1% of the prior month's loan balance. Whenever our cash balance is greater than $20,000, we're going to repay our loan, whatever we're able to. And right now we owe $10,000 on the loan. We have a 40% income tax rate, and we're going to pay our taxes for the current quarter next year. Okay. I know, a lot of information. So what we're going to do is we're going to take a 10-minute break and come back and put this piece together because I want your heads empty instead of full. Will that work for you?
Yes.
Okay. Okay. I'll be back in 10 minutes. Go walk around. Right. I could. Yeah, it would be good practice for me too. Send it to every coach, they can email it out. Okay, I'm back. Okay, so it looks like a ton here, but it's really not. Okay, it kind of is.
Yes, it is.
I'm like, as I'm looking, I'm going, okay, no, it really is. Okay, but what you do is you just think piece by piece. So first of all, you're only dealing with 1 month at a time. So the first thing that we're looking at is we're saying, okay, our beginning cash balance, that was given to us. We knew what that was. But for every other month, we take our ending cash balance, and that becomes our beginning cash balance. So our ending cash balance becomes our beginning cash balance, right? That part makes sense. Okay, so we're going to take our beginning balance, and we're going to add to it our cash receipts from customers. So this comes from our cash receipts budget. Is where we're going to get our cash receipts from customers. So we're going to do that for each month. Now that gives us our total cash available. So this is our next big line, is our total cash available, right? So we start out with our beginning cash, we add our cash receipts, and that gives us, okay, now this is what we have to spend. Are we good so far?
Yes.
Okay, so now, same thing here, we're just moving down. So this is where we started with. We know what we have available to spend. So now we're going to say, okay, what are we going to pay cash for? So we have to pay cash for direct materials. That comes from our materials budget. So if I went back the 70/60, if I went back to my materials budget, this is direct materials 10,240. Oh, but that's not what we spent. Cash payments, we spent 7,060, 10,040, 11,040.
So this is just for cash.
That's right, because we're doing the cash. This is just cash.
Got it.
We have material payments. And then we have our direct labor, comes from our labor budget. So if I went back to our labor budget, here we have 2130. If I went back to our labor budget, there's our 2130, our 4020, and our 2850 on our labor budget.
Got it.
So we have direct material, direct labor, and now we have our overhead. This comes from our overhead budget. So where the overhead is 1775, if I go to there's our overhead budget. And then we have our sales commission, which came from our labor budget, and our sales salaries of 2,000, and our general and admin expenses. These all came from budget. So all of this came from budgets. Okay. Now, when we get down here to income taxes payable, that didn't. That we were given in addition. We knew that we were going to pay 20,000 in income taxes. That was given to us here where we said, okay, we have an income tax liability of 20,000 that's going to be paid in October. So we know, okay, we have to go plug in that 20,000 in income taxes. And then we also knew, we were also told that we're going to pay dividends. So we've done this one. Then we were also told that we're going to pay dividends. Where's dividends? We were told we were going to pay dividends. Oh, here, cash dividend of $3,000 in November. And we already used our beginning balance. So we were told we're going to pay dividends in November. So we've put dividends in. Okay. Now I'm just going to move down so we can see more, okay? But we're on the interest on the bank loan. So our interest on our bank loan. So in October, we owed $10,000 the previous month. At 1% interest, it's going to be $100 this month. In November, we owed $43.65 at 1% interest, gives us $44. Now, we're not going to owe anything here because you can't see it yet, but we had more than $20,000 cash, so we repaid our loan. I'm going to move down so we can see more. Okay, so then the next thing we did was we purchased equipment. We knew that we were going to purchase equipment in December of $25,000 because we were given that purchase equipment of $25,000 in December. And here's our interest that we did. And this was our beginning loan balance that we just looked at the interest rate on. Okay, so now that we've done all of this, when we add them up, we have our preliminary cash balance. In other words, based on what we brought in minus the expenses that we know we have, there's our preliminary cash balance. Now, our deal is that we have to keep a balance of $20,000. If we have it, great. We're going to repay part of our loan. If we don't have it, then we're going to take out some from our line of credit, so we keep $20,000 in the bank. So right now our balance is $25,635. So we're going to repay $563 to the loan because our agreement is to keep 20. So we started out with the $10,000 balance on our loan. Now we have $20,000 in the bank, and we only owe for our loan $4,635. The next month, we have a total of $43,246. So we're going to repay the rest of our loan. So now we still have a balance of $38,881, and we have no loan. That's why we have no interest in December. So we're going to take our $38,881 balance, start up here with it, and keep putting down our expenses. All right, does that piece make sense?
Yes.
Yes.
Okay, we already looked at the loan interest. And we already looked at the equipment purchase. So basically, that's it. We've put down all of our expenses. So the cash budget is detailed, but it's just a matter of pulling all the pieces together. Okay, when we're all done, we can do the financial statements. When we're all done, we can put together the financial statement. So here's what we're going to do. So for the income statement, we're going to use our sales. It's going to come from our sales budget. So this comes from our sales budget. This comes from our materials budget. This is calculated. This comes from our selling SG&A budget. This comes from our SG&A budget. This comes from our SG&A budget. Interest expense comes from our cash budget. We were given the rate of our income tax at 40%. So we're going to take, here's our income before income taxes times our income tax rate gives us our net income. So do you see how we pulled all those pieces together to get the regular expenses and all? And if you look at like last year's income statement, you'd say, oh, I know where I have to go find all these pieces of information. It's not like you create it from scratch. All right, does the income statement make sense?
Yes.
Yes.
How about it for everybody else?
Yes.
Yes.
Okay. All right, last one's the budgeted balance sheet. It's actually easier. So the cash comes from our cash budget, obviously. The accounts from receivable comes from our purchases budget, because that's where we purchase for supplies, and half of them or all of them we pay next month. And oh, sorry, I have it mixed up. Accounts receivable is sales budget. And accounts payable is materials. What did I say? Accounts payable, purchases budget. And then our raw materials inventory is from our materials budget. Finished goods inventory is from our production budget. These you're going to get from historical data. Plus, like with the equipment, if we're looking at December, you know that we purchased new equipment. So you would look at your capital budget and your cash budget for like new purchases. And for our liabilities, our income tax payable comes off of our income statement. The common stock and retained earnings are historical, unless we issued new, and we're done. Okay? I know it's like, okay, until you try and go do it, which is what we're going to look at now. Let's see. I'm going to go to week 3. These are good videos, by the way. Okay. So let's look at this. So let's say that we're going to do a sales budget. We're going to sell 500 units in April, 580 in May, 530 in June, and 600 in July. And to do that, we plan to produce 442, 570, 544, and 800 and 540. Okay, the company plans for finished goods inventory of 120,000 units at the end of June. In addition, each finished unit requires 5 pounds of direct materials, and the company wants to end each month with direct materials inventory equal to 30%. Okay, blah, blah, this is a lot. They give us beginning direct materials. Okay, so for direct labor budget, let's just look at labor so far. Each finished unit, so we're going to focus on labor. So each finished unit requires 0.5 hours of direct labor at a rate of $16 per hour. The company budgets variable, oh, that's a variable overhead. Okay, so just for labor first, 0.5 hours at a rate of $16 per hour. So if we go down here and we say direct labor budget, okay, we plan to produce 442, 570, and 544. 0.5 hours of direct labor. So I'm going to put 0.5 here. That didn't work. That didn't work either. Seriously, I got myself out of it? Well, whatever I did, that was stupid. Zero 0.5. Did that work? Yes. Okay. 0.5, 0.5 hours per unit. So, oh, they're not going to do the math for me? 221, right? 570, 235? No. What's half of 570? 235. 255, no. Come on, you guys, my head's not working.
285.
Thank you. 285 and 222.
272.
272. Okay, so now how much did we say labor costs? $16 an hour. And that's the same for every period. Oh, now they'll do the math. All right, so that's how much I'm going to spend on labor. So far, so good?
Yep.
That was doable, right?
Yeah.
Okay, so requirement 2, overhead. All right, so when we look at overhead up here, we're going to see, what does it say about overhead? What? What does it say about overhead? So it says variable overhead at the rate of $20 per direct labor hour and fixed overhead at $8,000. So variable is $20 per direct labor hour and fixed is $8,000. All right, so we're going to go down here. We'll say total labor hours needed. Oh, well, we better go back here and look. 221, 285, 272. Are the months the same? Yes. 221, 285, 272. 221.
285.
Thank you. 280.
285.
272.
And then
Variable factory overhead.
rate. And what did we say, 20?
20.
And budgeted was 8,000. If you do it in pieces, it's not so overwhelming. Okay. Are we good here?
Yes.
Yes.
Okay, so now we're looking at the production budget. So Blue Wave Company predicts the following unit sales for the coming months. So for September, we plan to do 4,000 units, October, 5,000 units, and November, 7,000 units. Now we have to know, what do we plan to have in ending inventory? So we want to,
Hello? It
Don't
says,
we need the ratio?
it says next month's budget sale. So we need to put
production budget.
October's budget on September.
Ratio of inventory to future sales? No, wait, what do they tell us? Production,
Yeah.
For the first
4,000. Oh, okay. The company policy is to maintain finished goods inventory equal to 60% of the next month's sales. So
should we put 5,000 instead of 4? Because it's
So,
next month's sale.
oh, next month's budgeted sales, yes. I'm used to doing it differently. So October is 5,000. November is 7,000. December is 7,600. 60%. 60%.
Budgeted ending inventory.
Really, they're not going to calculate it? What's
3,000.
how much?
3,000. 4,200. 4,560.
Okay, so that's what we need to have in ending inventory. Now we have to have, what are we going to have to produce now?
The budgeted sale for
So
the month.
yeah, so for September, we need 4,000 units. For October, we need 5,000 units. And for November, we need 7,000 units. Minus Oh, we have to put a heading here. No, there's no heading there. Minus what we have left in beginning inventory. Did they give us our first beginning inventory?
24,000.
2,400.
100.
Right, 100 units on hand. And from here, we fill it in from here. So what should my beginning inventory be in October?
Ending inventory of September, 3,000.
Right. And what about for November?
4,200.
Yep, perfect. You got
Do
it.
you add beginning inventory units? Or
Yes, because you're looking at, no, you subtract beginning inventory. Because we're saying, okay, we need to produce a total of 7,000 units to meet everything. Or not produce, we need 7,000 units to meet our needs. But we already have 2,400 in beginning inventory, so we only need to produce 4,600 more.
yeah, so your thing, should we change it to less beginning inventory?
Oh, why
Yes,
does it
yes.
add? Yes. Oh, I didn't even see that. I just scrolled down far enough. Yes, you should change it to that. Since that's what it's doing.
I have a question.
Mm-hmm.
Where it says next month's budget and sales, is I see September, October. I don't see how we got that.
They gave it to us in the data because next month's budgeted sales, they said September was 4,000, October's 5,000, November's 7,000, and December's 7,600. So we're looking at, we're figuring out to begin with, what do I need for next month? And then what do I need for this month? So for next month, I need 60% of next month's sales. So in October, I'm going to sell 5,000 units. So I need 60% of that produced in September because I want it at the end of the period. I also need to produce whatever I need to sell in September. So I need to produce 4,000 units for September. Does that make sense?
Not really.
Yes.
So what we're doing is we're starting out with, this is what we need to have.
I guess when I see September up there, I see 4,000. Then when I see down
Right.
here, I see 5, I guess.
Because this first we're figuring out what we need left at the end of the period. So we're saying next month sales. So for next month, so in September, I want to have at the end of September, 60% of October's sales sitting there, ready to ship out. So I'm starting off with, I need to begin with 60% of next month's sales. So that gives me 3,000 units. Plus, I'm going to sell this period 4,000 units. So this is my this period sales. So I need a total then of 7,000 units to meet all my demands. I already have 2,400 in my warehouse, so I just have to produce 4,600 more. So now in October, the first thing I need to do is I need two things. Every month I need two things. I need 60% for next month. Because I want those left over at the end of the period, so I have to produce them this month. And 2, I have to produce everything for this month.
Okay.
Okay?
Well, is it easier to do a roll at a time, or?
Well, you couldn't really do a row at a time unless you had a formula that filled it in so you knew this.
Okay.
So here we'd say, okay, so for October, I would say, okay, the first thing is let's deal with ending inventory. So for October, I need, in November, I have 7,000 units for November. So here's my 7,000 units for November. At the end of the month, I want 60% of them in inventory. So that means I need 4,200 units in ending inventory.
Right.
Plus, in October, I have this 5,000 units that I'm going to sell. So I also need these 5,000 units. So I need a total of 9,200 units. But I already have 3,000.
Mm-hmm.
So that means I only have to produce 6,200.
Mm-hmm. Okay.
Do you want me to do November?
I got that part. It's
Okay.
just the part it was confusing to me, like the first line, next month's budget sale unit, where I guess I'm confused because when I see up at
Well-
the top 4,000 for September, and then I see 5. That's where I got.
Right. So, and actually it confuses me too in the beginning on here because I'm used to doing the budget where I start with this month and then I add what I need for ending inventory.
Okay. Right.
So I'm used to doing it the other way,
right.
and it doesn't make any difference which way you do it.
Mm-hmm.
Like if I had a spreadsheet, I would just show you, except for it's confusing enough one way. But you could start with, this is what I need for this period. And then this is what I need for ending inventory. 60% of next month's sales gives me my total. You could do it that way too.
Can
Okay.
I say something?
Yeah.
The reason why the 5,000 is there, I know why I understand your confusion because I had it too. The
Right.
5,000 is there because when they say next month, you have to plug in whatever the total is for October. So the 5,000 corresponds with October. So that's why they put it there instead of the 4,000, because that next month budgeted sales is looking for the 5,000.
Okay, I see.
And the reason that I like flipping them and doing the budgeted, it's like when I learned it, I would do
I see. I see.
this
So
part
like,
first and then this part second. And it was easier because then you would just jump to the next month and pull that percentage down.
okay, just like for October, next one would be the 7,000 for.
Exactly.
Okay, I
Because-
see it. I see it.
Okay. Like,
Okay, I get it.
so we're starting back. You could do it either way. I like it better the way I learned it,
Mm-hmm.
but that's just going to confuse you because it's here this way.
Okay.
But that's what we're doing. It's just we're taking into account what do we need for this period? What do we need for next period?
Okay.
Okay. I'm glad we talked that through. See, don't go, especially when it's something that's complicated like this, don't leave with questions thinking it's probably just me. I'll just sit home and I'll figure it out on my own because I don't want to ask something because
I was thinking that too.
Yeah, because but see, it isn't just you. It's never just you.
Okay. Thank you.
You're welcome. Okay. I'm going to let you play with this because we can do more next. I want to show you briefly. But there isn't a lot because we have variance analysis. I want to get at least started with it. Okay, so flexible budgets. The first part's simple. Okay, the variance analysis is the important part in this chapter. Let me just start with, can you see the PowerPoint?
Yes.
Okay, good. All right, so fixed and flexible budgets. So the only difference is that we're going to adjust our budget to the actual amount of sales so that we're looking at apples and apples with our expenses. Because like the example I gave you before, if I got a big contract that I wasn't expecting, my sales might look great, but my expenses, you're going to be going, well, you're way over in labor and you're way over in materials, and what is wrong with you? So that's why we have flexible budgets. So here is what a budget report would look like. So we have our fixed and our actual, and then you have your variances. And I want you to notice that with variances, this favorable or unfavorable is a very important part. Because if I said for sales dollars that you have a $25,000 variance, you might go, oh, that's great. You know, I'm like, no, we spent too much. Oh, that's bad, right? So whether it's, you're not done with your answer until you say whether it's favorable or unfavorable. Now, what we're looking at right here is, this is our like fixed budget. This is the budget that we just did. We haven't adjusted it for sales or anything. But this is the way variance analysis works. But we're gonna get into detail where we can break it into an efficiency variance and a an efficiency variance and a price variance, because the question isn't just how much are we over or under. There's two components to that. One is, are we over or under because we used too much or too little materials, or are we over or under because we paid the wrong amount? For instance, I could be over in labor expense, but it might not be that I have too many people working. It might be that I have too few people working and I'm paying overtime. Or it might be that I hired somebody in at way over our budget, and so I'm paying too much. Or it might be that I'm paying the amount that I plan to pay, but we're working too many hours. So you have to be able to break the variance, which is a formula that I have, break the variance into whether it's, are we using too much of a quantity, whether it's labor hours or materials, or are we paying too much? And the reason it's really important to break it into those two pieces is because one variance can mask another. For instance, I might be using too much materials, but I got them at a better price than I anticipated, so it doesn't look like there's a problem. But using too much in materials is still an issue. It's still room for improvement. So this is just for the basic, like here's our variance, right? And so we get down to the bottom and we have a total favorable variance, but you would still want to look at, okay, I spent too much on expenses, why, what happened, especially, okay, so I'm over in sales dollars, woohoo. See, this probably looks like we sold more than we planned to sell. And if we sold more than we planned to sell, we would expect the expenses to be over, especially any expense that is related to manufacturing. So like our depreciation on the office equipment, there's nothing wrong with that. Our admin salaries, those wouldn't change. Office supplies might. Insurance expenses, see, that shouldn't be over. That would make me wonder why. But shipping expenses would be over. Sales commissions would be over. Depreciation on the machinery wouldn't, but utilities would be over, and factory supplies would be over if I sold more. So would my direct materials and my direct labor. So it looks like what happened here is we did our budget, and we planned to sell 10,000 units, but instead we sold 12,000. So woohoo, but that's going to throw off all of my analysis. I can't really tell if I'm over or not. So because of that, what we're going to do is we're going to do a flexible budget. And all a flexible budget means is that we're going to adjust our budget for what we actually sold. Now, like I said, your book will tell you, oh, we'll do it at all these different levels so that we're prepared for anything. But in reality, because we have Excel and because it's really easy to change the numbers, all we're really going to do is, oh, we sold 12,000 instead of 10,000. Go change that number and it'll change everything in our budget. So with the flexible budget, our variable costs are going to change, but our total fixed costs aren't going to change, which we just looked at. And obviously the fixed costs aren't going to change. So when you have, so this is what I'm saying where they show you, okay, here was our budget, and now we're saying we're going to prepare it for 3 different scenarios. What if we sold 10,000 units? What if we sold 12,000 units? What if we sold 14,000 units? Where in reality, what we would really do is just say, we sold 12,483 units, go plug that number in. But the concept's still the same. So like here, we know that our sales are $10 per unit. Our variable costs are $4.80 per unit. And here's our contribution margin. So if we sold 10,000 units, we know what our sales are going to be at $10, what our variable costs are going to be, our contribution margin. So we basically adjusted our budget based on what our actual sales were. So now when we look at the performance report, now we can say, okay, so this was our budget if we sold 12,000 units. And this is our actual, like what our financial statements actually say. So if we sold 12,000 units, now we're comparing apples and apples. So if we sold 12,000 units, we plan to get $10 per unit, which would be 120,000. Somehow we managed to get 125,000, so we went over on sales somewhere. So we have a $5,000 favorable variance. Our variable costs are supposed to be $4.80 per unit. So based on our budget, it should have been $57,600, but in actuality, we spent $59,400. So we have an unfavorable variable cost. And of course, this is rolled up into such, we've lost all the detail, so we can't really go investigate anything from here. So we're just looking at a high level how it works. So our contribution margin should be $62,400. Because of our sales, it is $65,600, so that's a favorable variance. Our fixed cost should stay the same, but we're off by 200, so that's an unfavorable variance. So when we add all that up, we have a $300 favorable variance. So one thing that I want to point out is this is like adjusting for a flexible budget. But the other thing that I want to point out is when you have a variance, whether it's a favorable variance or it's an unfavorable variance, you still want to go investigate. It's not good enough to say, well, woohoo, you know, we should have sold 12,000 units for 120,000, but we sold it for 125,000. Yay, we're over. You still want to go find out, why are we over? You know, what happened? And same with unfavorable variances, even if they're small, you know, like the $200 fixed cost variance, I'd want to know why is there a $200 difference? And this is especially true in areas that aren't fixed, because it's possible to have a much higher variance on like materials and then a low one on cost, and they kind of mask each other and you miss it. So you're looking for ways to optimize performance. So everything in our budget is based on what's called standard cost. And what standard cost means is that's what we built our basic budget on. Standard cost is what we expect to pay for the materials, what we expect to pay for the labor. That's our standard cost. And then what I mean by exception reporting is you only look at and investigate where you see there's a problem. So you do the variance analysis. You don't have to go look at everything. You just go look at where there's a difference. I can't believe I didn't take these out. Okay, so this is how we break it into, and we're going to spend the beginning of our next class on breaking the variance analysis into price versus quantity. So whether we're talking about like direct materials, did we pay too much or did we use too much? Direct labor, did we pay too much or did we use too much? Variable overhead, did we pay too much or did we use too much? So everything we look at is going to be based on, did we pay too much or did we use too much? And is one hiding the other? Like, did we use too much but pay less than we planned? So the variance is small, but there's still really a problem. So with standard, this is easy. This is just what we've been looking at. So direct materials, we plan to use 1 kilogram at $25 per unit. So our standard cost is $25. This is just how we built the budget to begin with. You know, like our direct labor, we plan to use 2 hours per unit at $20 per hour is $40 per piece that we manufacture. When we look at our cost analysis, if the actual cost is more than what we had planned for it to be, the standard cost is our budget. Or what our plan was, right? Standard cost is what our budget or what our plan was. So if the actual cost is more than what our plan was, then we have an unfavorable. If our actual cost is less than what we plan to spend, then it's a favorable variance. And this is what we're going to save for next week. But I actually have, oh good, it does it that way. I actually have a way of showing it to you that breaks it down. If you look at, this is what we're going to spend a lot of time with. This model, once you know how to put the numbers into this model, it answers itself. So just so while you're looking ahead, what happens here is this side where we compare price variance right here, we're separating price because we have actual, and standard price. So we're separating out price to get the price variance. And then on the other side, where we're trying to do our quantity variance, we have actual, standard is standard, and we're separating out our quantity. So we figure out standard, actual quantity. So here we do price, actual, standard price, and on this side we do standard, actual quantity. So we're separating out here the price and here the quantity. And that's how we figure out what the price variance is and what the quantity variance is. And if you like formulas, some people love formulas. If you like formulas, all you have to do is this. Those two formulas. So if you're a formula person, focus on that. If you see it visually like I do, focus on the table. And that's going to be our focus for the beginning of next week. The beginning of Thursday. And then the last chapter doesn't have a lot in it. This is the big stuff. Okay. How do you feel about this?
Yes.
Eh?
It's a little trickier than the one before, but
It is a little tricky, but once you work through it, it gets easier. So work through the budget problems before Thursday so that if you have questions, we can look at them. You can look at the variance, because if you look at it before we start it, you'll do a better job with understanding it as we start working through them. The biggest challenges that I've seen is like in the data itself, understanding, oh, this is the actual, oh, this is the standard, you know, to put the numbers in the right places. But it's doable. And it's
Sounds
easier
good.
than last week. But don't forget last week, because the final exam's cumulative.
Okay.
I know, right? Hey, it's 11 o'clock here, right? It's easier if it's 8 o'clock, right?
right.
Okay, work on it. Call me if you have questions. I did write down on the calendar, which I'll make sure I take with me tomorrow, to look at that test question. I think it's already in my briefcase, so I won't forget it. I have a tendency to do stuff like that. And so I'll look at that, and I will post an announcement or send out an email. And if you have any other questions, let me know. You should be able to see all the test answers and the feedback now. I will also go in. I heard from a couple of people that were having trouble with homework. I will also go in and change the settings on that when I'm done talking here so that you can see the answers on your homework for last week. So if for some reason you had trouble with it, you can see it and go back and study. Okay?
Awesome.
Doesn't mean I'm not willing to talk to you also. I'm totally willing to talk to you tomorrow. All right?
Awesome. Thank you.
Okay. I'll see you guys on Thursday.
Thank you, Professor.
Thank you for
Thank you.
coming. All right. I'll talk to you later.
All right. Thanks.
Recording. Good night.